All right, welcome to Rain King Insights, a website to teach investors how to growth stock invest successfully. Now, and this is a GMU extra in the Sun Shower series. We're going to look at this short form video. We're going to look at some common trading bad habits. All right, we all make mistakes in trading, particularly when we're just getting started the first few years. And we look at those as kind of tuition that we pay to the School of Wall Street. We all have to pay tuition. The question is, how much do we have to pay? Now, there are some bad habits that young traders consistently make. So we're going to review 4 of those bad habits, common ones, in this video. The first one, number 1, is traders that are seeking action in the markets versus stacking their odds and their edge. Number 2, a lot of investors, when they're starting out, have absolutely no rules. Number 3 is the fear of missing out, FOMO. People get excited and chase stocks. And number 4 is revenge trading, and we'll review that and why it happens. Let's dive in. Bad habit number 1 is young investors seeking action in the markets and gambling versus stacking the odds in their favor. Really, as a trader, you got to have a plan. You got to have a risk management plan to preserve your capital. And one of the things that's so fundamental is you need to know what your edge is going to be in the market. And the edge is really composed of 3 sides of this triangle. You need to know some basic statistics on your trading. You need to know what your average gain is. You need to know what your average loss is. And you need to know your batting average or your win-loss ratio. Those are critical to help form the basics of a risk management plan. Now, as you build your plan and you're looking at your average gain and average loss, it's important to understand the ratio between the two. In this example, I've used an average gain of 15%, maybe your average loser is 5%, and that ratio becomes really your 3-to-1 trader. Your gains are 3 times your losses. You need to know that ratio because that becomes really important. And you also need to know your batting average. In this example, I'm using 400, meaning that out of every 10 trades, you're going to be successful 4 out of 10 trades. You're batting 400. And this simple table is helpful because if you take your batting average, which you can call your win rate, and if you're a 40% average, you're looking at this column. And then we look at your ratio, 3-to-1. So you're a 3R trader. For every dollar risk, you're looking for a reward that's 3 times your risk, 3R. 15 is 3 times your average loss. So if we look at the intersection of a 3R trader and they're batting 400, you'll notice that the table is green, meaning if you can consistently maintain those numbers, you will be profitable. It's simply math. Now, you can also look at all the other combinations. You can be a 2-to-1 trader, but you have to really have a good win rate, at least 400. You can even be if you are a 6R trader, you can only be right 2 to 3 times and still be profitable. That's hard to do. So it starts with knowing your numbers. If you don't know your particular numbers and you don't know where you're fitting in on this chart, you don't have much of a chance. For instance, if you're a 3-to-1 trader, but you're only successful on 20% of your trades, you're going to be red. You're going to be unprofitable. So you have to know your numbers. The second thing that will help stack the odds is knowing those numbers. And you might ask, well, if my gains are bigger than my losses, how can I possibly lose in the market? Well, let's look at it and break it down. If you have a 400 batting average and your average gain is twice your average loss, in this example, a 4% average on your gainers, 2% average loss on your losing trades, so that's a 2-to-1 ratio. If you look at 10 trades and maintaining that with the same position size, your profit will be 3.63% over the 10 trades with this particular combination of numbers. And you'll say, well, how could I possibly lose? Well, let's look at it. Let's keep the same batting average. Let's keep the same ratio of gain to loss, but we'll say that you are exceptional at your wins. You're getting 42% average gainers, but unfortunately, you don't cut your losses, and you're taking 21% on your average loss. So it's interesting because the batting average is the same. The ratio is still 2-1, but over 10 trades, you will actually lose money. You'll be down 1.16%. So you have to cut losses. This is the math that really, really rationalizes what you must cut losses, because losses work geometrically against you. They're very difficult to recover from. If 6 trades lose an average of 21%, you're going to need 6 more winners that actually need to be 25% winners just to break even. So you can't let losses get too big. Once losses get above 10 to 12%, it becomes very difficult to recover. So let's go to bad habit number 2. This is really the trader that has no rules. Now, trading really is a game of making decisions. You make the decision to buy a stock, you make the decision to hold a stock, or you make the decision to sell a stock. That's in your control. You can't control the markets. So if you don't have rules controlling why you're buying or why you're selling or even why you're holding, you're going to get caught up in the emotions of trading, which is a big, big mistake, common. Trading can be highly emotional. You'll see your account go up, you'll see your account go down. It'll be very emotional. And your psychological biases will be brought into the market. And if you don't have rules, you're going to be very emotional, and it's going to lead to irrational decisions. Happens all the time if you've had 2 successful trades in a row, you're going to be very attached to the third trade, thinking it must work. And you're going to make some really, really decisions that probably are not logical when you do your post-analysis. Now, rules are designed to help keep those emotions in check, particularly when the bullets are flying and you've got a live position in the market. You have to do your post-analysis and be really honest with yourself and what you're doing well and where your mistakes are. And then you'll create a rule set that will actually help you improve your weaknesses. And it will be a rule designed around your trading. Bad habit number 3, which is also extremely common amongst traders, is the fear of missing out, FOMO. You've probably heard the term. Fear is probably the most powerful force that drives trading decisions. There are really 4 fears. The fears are fear of being wrong, fear of losing money, fear of missing out, and the fear of leaving money on the table, which essentially is greed. So I have a video in the free section, free content page at Rain King Insights, where I do, I don't know, a 30, 40-minute talk just about these 4 fears. I encourage you to go watch that. So the fear of missing out is really emotions. You're seeing other people have positions, they're making money, you didn't buy anything, or you're late, you weren't prepared with a watch list to buy anything, and you feel this real emotional impulse to say, I got to buy something. And you tend to buy stocks that are extended in price, and you start chasing stocks because you're worried that you're not going to be able to participate and you're going to miss out because all of your friends and trading buddies are making money and you're just sitting there. The reason this is so powerful is because you have no rules. You don't have rules that time your entry into the market. You don't have rules for while you're buying stocks, and you end up compromising and taking marginal setups because you want to buy something, anything, just to get into the market. And usually you'll be buying stocks when they're too extended and they'll pull back and you'll have losses. You chase stocks and you don't have a risk management system. You don't know where you're going to cut your position to cut those losses so they don't get too large. This is all an emotional impulse. It's a very common mistake, but you got to have a trading system that actually addresses buying, selling, risk management in order to avoid getting sucked into FOMO. So you got to slow down. You need to stay within your trading setups, your rules. You need specific criteria for when you're buying strength, perhaps breakouts, and when you're buying weakness. And you have to have a very defined setup of how you're going to buy pullbacks and control your risk. If you're not doing this, you're making a very common mistake, and it's a bad habit because sooner or later you're going to be taking losses that are bigger than you had planned. All right, bad habit number 4. This is revenge trading. And this again is about emotions. There's a very impulsive feeling when you take losses that you need to make those losses back really quickly. If you've taken 2 or 3 trades in a row and you've lost money, you're going to say, I want to get back at the market. I want to get my money back. And that's a very, very emotional pull, and it's a very bad mistake. Just because you take 2 or 3 losses in a row doesn't mean you should load up on the next trade. You'll probably end up digging the hole deeper because something's wrong with your stock or something's wrong with the market. So it's a very common mistake, revenge trading. You have to realize that trading is about probability and odds. Every trading system, whether you're trading strength or weakness, whether you're trading breakouts or reversion to the mean, all trading systems have losses. And you really need to look at losses as feedback from the market. Maybe you were just wrong on the timing of the particular trade. Maybe the general market was topping out or correcting, and you were trying to buy stocks aggressively. You simply weren't in sync with the market. So it's all about how you perceive losses. Don't take them personally. They're not personal, but you need to control them and keep them small. And sometimes the market will push you out and you should regroup versus trying to get back in and double up on your trading. It's a bad habit and it's a bad mistake. So do your post analysis, evaluate the market conditions, and stay disciplined. There will be a better time to enter the market or a better setup that will present itself, and it may not come until a week after you've taken 2 or 3 losses in a row. Avoid the impulse to get right back in. All right, we've covered in this short video 4 trading mistakes that are really bad habits of traders. So we all know we're going to make some mistakes, but we kind of keep them small, and we want to minimize the tuition that we have to pay to the market. So if you like the content in this video, just go to rainkinginsights.com. We have the GMU Extra Sun Shower Series. It's free content. I've got dozens of these short videos. You may like the different topics that are presented. And we'd love to see you check out our content and be a member of Rain King Insights. We have educational material for new traders with only 0 to 2 years experience, all the way up to experienced traders with 10 years plus in experience. And we go over some very advanced concepts. Thanks, everybody. We'll see you on the new and the next GMU Extra.